Good morning from our global headquarters in New York. I'm Manus Cranny alongside Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
The last piece of the jobs jigsaw drops today. Non-farm payrolls expected to show a hiring bounce. And warning signs from Chicago Fed President Austin Goolsbee. He sees the potential for multiple cuts over the next year. And another chips setback. The U.S. doubles down on China's semiconductor access. Broadcom sales forecast disappoints. Good morning, Manus.
Danny, good morning. There seems to be a preparation for pessimism on these jobs numbers. Only two numbers you need to keep in mind. 165, which would be a jump from July, and 4.2% on the unemployment rate. You have this preparation for pessimism. You're looking at the Nasdaq down 1.25%. Broadcom is down. The chip sector under pressure again. More curbs coming from America towards China. What is the reverberation of that? Yields really trying to find their mojo. This market is one breath away from a 50 basis point cut, and as Goolsbee says, multiple cuts along with Mary Daly. We'll talk more about that in terms of the narrative, but this market is one breath away, or one non-farm payrolls away from that 50 basis points potentially being a reality. The dollar is on the back foot. Yen is much stronger this morning. Kuroda, of course, the former governor, talking about the neutral rate in Japan. Wouldn't quote the level, but he did say it's nearer to 1.5% to 2%. So there's a mile to go to higher rates in Japan. Danny.
There's so much emphasis being put on today's jobs report that happened at 8:30 a.m. And you mentioned Goolsbee. The thing that stuck out to me of what he said, Manus, was this. I don't want us to be basing decisions on one data point. Basically pushing back against the idea that the data point today is going to be the determining factor between 25 and 50 basis points. So is the market putting too much importance on it?
Look, I think we become very myopic because it does hold a great deal of significance. Suddenly, we do look at ADP a little bit more and the jobless claims. Daly talks about a downward descent, and I think we're going to hear from Williams, we're going to hear from Goolsbee again a little bit later on today around the jobs report, but it feels very precarious. You know, it's, as I say, we're one bad print away from cementing a 50 basis point cut. That's very much a live proposition.
Well, part of the reason people are so nervous is because of what happened last month. Let's be honest. After you get the jobs report, you have a yen that slides, dollar yen that slides through 144, the worst day for Japanese equities since the 1980s. But is this time different? The data hasn't been as negative over the past week. Jobless claims wasn't that bad. You had ISM services come in strong. The data is a little bit more uneven than last time. And you had that BOJ hike last time, too. I
thought it was ironic. You suddenly get people really hanging their hat. And indeed, Andrew Hollenhorst will be with us from Citi a little bit later on, talking about the beige book. 9 out of the 12 districts. Suddenly, the beige book takes on a whole new meaning. Paul Donovan at UBS, I think, encapsulates it beautifully. It's the fear of unemployment, and that negative feedback loop. So long as companies are not cutting jobs materially, then that fear perhaps lies in abeyance.
Yeah, really looking forward to that conversation with Andrew Hollenhorst from Citi. So it was the rupture caused by last month's jobs report, and now traders are bracing for the next round of data that happens again 8:30 a.m. Let's get over to Bloomberg's Rachel Evans. Rachel, what's at stake?
Yeah, well, I think you guys laid it out very nicely. It's really this question of whether we see a 25 basis point cut or a 50 basis point cut being priced in after the jobs data. I think traders are really going to be watching to see to what degree we either get a miss around that kind of forecasted 165,000 level or a beat over that. Do we see some of the data that's kind of suggested that the US economy is holding up well? Is that kind of confirmed by, a suggestion that maybe the last jobs print was an aberration and that the labour market is also holding up well? Or do we see that deterioration that we were hinted at in that kind of previous report, which prompted, as you pointed out, so much kind of turmoil in the market? Is that something that we see kind of come through again? And we've really seen kind of like the market positioning for that over the last few days. People are very long, treasuries in particular, expecting to see some confirmation that we are going to be heading towards those bigger cuts. So the market is geared towards expecting to see kind of a miss, a lower print in the jobless claims today, in the jobs data today, whether that's on the unemployment side or on the kind of like key payrolls figure itself.
Yeah, it does feel pretty precarious at the moment. The issue really is to whether a Goldilocks narrative can be affirmed or whether we're going to something deeper, as Citi says. They've shifted to a recession, no longer a Goldilocks scenario. How quickly we've pivoted.
Yeah, I mean, I think that's it. I think that the market has really had to start pricing in this deterioration very aggressively. You know, we've seen kind of 2-year yields, the most sensitive to interest rates, moving down 80 basis points over the last 6 weeks or so. That's a huge sum that we've already kind of seen rates rally. So I think the question mark is now going to be how much further can people position for that recessionary environment? You know, it seems like the soft landing is still something that the stocks market in particular is kind of pricing in. Do they start to actually price in that harder landing? The bond market has already rallied so far, and we've already got, I think, 110 basis points of cuts priced in for this year. That's at least a 50 basis point cut once, maybe even twice. So to what degree can we actually see, you know, more bearishness in the market, more dovishness priced in, given that we're already expecting quite a large number of aggressive cuts this year?
Yep, it's surely true that the bond market is prepared for a pretty bad print. Rachel, thank you very much. Rachel Evans, there, Bloomberg reporter. State Street's Marija Veitmane joins in the narrative, the impact of today's jobs data, writing this. Labour market is not a source of inflation. This is a perfect message for the stock market. It means that the Fed will be cutting rates to support the labour market, which equals the economy, which equals the stock market, at the sign of further weakness. Marija joins Danny and I now. So, Marija, just listening to the setup there, the bond market is prepared for a pessimistic print. Do you think the equity markets, I know they're dipping this morning, but are they still holding on to Goldilocks for dear life?
Yes, hello. I think I really want to agree with what Danny was saying in the kind of in introduction is it's not about what we see today. It's about kind of overall labor market. Yes, we know labor market is softening, and but it's not collapsing. We are not saying people like huge layoffs and huge drops in corporate profitability and bank lending and things like that. Yes, we are slowing, we are adjusting. That's exactly what central bank wants. And what Fed told us is that if we see further deterioration, if we see a big concern, we are there to step in. So I really struggle to see a more positive message for equity markets that any central bankers could have given us. So yeah, I'm trying to stay constructive.
Marija, this is my favorite line from your writing, which I think encapsulates where you are right now. Bad news is good news. Good news is good news. But very bad news is bad news, if you can kind of wrap your head around that. So the only scenario that's bad for equities is very bad news, essentially. Marija, what constitutes as very bad news? What is the bar for that?
Oh, well, we probably need to see negative payrolls. Then, okay, labor market is really bad and we're really going into really serious slowdown. But I mean, looking at the various different data sources, okay, corporate earnings were okay-ish. I mean, we had positive surprise, we have negative guidance, but we're not saying terrible things. Consumer spending, again, consumer is spending, yes, a lot of it on credit card, a lot of it in maybe cheaper goods, but we still spending. Bank lending, okay, it's not growing, it's kind of flowing, but again, it's not complete deterioration. So to us, it's not really that very, very deep recession. And even if that happens, I mean, we don't see huge imbalances in the economy again. So we still see liquidity, we still see lending. So we are really going for kind of not bad news.
Not bad news. Okay, well, let's see how bad the news is today, because the bond market's saying one thing, the equity market is saying another. You say it's too soon to rotate. Why?
Yeah, that's a really interesting question. And I have to say, I've been asked about small caps and value stocks and cyclical and non-US stocks again and again and again. They have really underperformed for a long time. We've seen signs of rotation there. My big concern about this rotation is that, yes, we're having potentially Fed put. Yes, we're having big sell-off in tech. So where do you go? I question small caps, because that's where we see the biggest weakness in earnings. Yes, we had investors were disappointed with tech earnings, and Nvidia profit margins were only 50%. I mean, look at small caps. They're actually places where they're losing money, and we're seeing really, really significant earnings downgrade. So no, I don't want to go into those stocks. I want to stick to quality. I want to stick to large caps. That, to me, a better protection if something happens.
So that rotation you don't like. But I even wonder within large caps, you have seen this bid to bond proxies. Utilities up something like 5% over the past month. Real estate is up 13 percentage points versus tech, versus the wider market, rather, since mid-May. Can these sectors continue their outperformance on just that assumption that the rate cuts are going to come and they're going to continue on?
Yeah, real estate is something that I actually quite like, and mostly because of investor positioning. We know that investors are super underrate real estate, and you said that, like you said, it's rallied 13%. So anybody who has this underweight in their portfolio, they need to close, they need to buy, and this buying will continue until at least we go back to benchmark. And like our data suggests that investors are still very, very deeply underweight. I mean, the other place we like maybe pharmaceuticals, so that's your large cap, that's your quality. That's very strong cash flows. Again, places that we like right now. So quality and size are. So maybe if you're not as bullish and huge tech lover as myself, maybe healthcare is a good alternative.
Well, we like the fact that you're a constant barbell, tech on one side, and cash on the other. Look, utilities, just to pick up on what Daddy said, are up 21% on the yield. The dividend there is near 3%, so it's almost double the broader market. If in an AI play, you're looking for alternative slots in AI, that usage of electricity, that usage of energy in a hungry AI world, can that be part of that utilities narrative?
I mean, potentially. I mean, I'm not 100% bought on the story because the reason tech is making so much money out of AI because they invested enormous amounts of money. Utility companies, yes, there would be a huge demand, but they still need to invest. That investment has not happened. The infrastructure is still kind of not there. Yes, demand increases, but you need to invest and then kind of generates huge return. So I think utilities would be quite a way below my ranking behind tech.
Hey, Marija, let me just say, in a market setup that feels dour, it's wonderful to hear your bullishness today. It's a nice dose on this Friday. Marija, we appreciate it. Good luck for the report later today. State Street's Marija Veitmane. Okay, Manis, let's talk about some of the other top stories that are trending on the terminal this morning. Apple has greenlit a version of Tencent's WeChat app ahead of the iPhone 16's debut. That does buy more time for negotiations between Apple and WeChat over App Store fees.
In a pitch to Wall Street, and New York's corporate leaders, Donald Trump pledged to cut the corporate tax rate to 15% for companies making products here in the USA. Trump promised to, quote, low regulations and low interest rates.
China is combining two of its largest state-backed brokerage. The aim, create a new giant that can compete with overseas financial firms. The deal is pending approval from the company's boards, shareholders, and regulators.
Coming up in the show, the U.S. targeting China with fresh chip export curbs. That's hitting the chip sector this morning.
And later in the hour, we're going to sit down with Citi's Andrew Hollenhorst as we count down to the August payrolls report here on your Bloomberg Brief. You're watching Bloomberg Brief. Danny Berger and Manis Cranny in New York. So chip stocks leading futures lower this morning. Broadcom down some nearly 10%. We'll talk about that stock individually in a moment. But in the meantime, the bigger story, the U.S. is joining its allies in imposing chips-related export curbs that target China. Let's bring in Bloomberg's Tom McKenzie on this. Tom, another day, another headline about export curbs on chips to China. What's different this time?
Yeah, that's certainly what it feels like, doesn't it? And in terms of the direction of travel, we should expect these measures to continue. Here's the difference then. October 2022, that was the earthquake moment in terms of this tech battle between China and the US. That's when the US imposed these restrictions, not just on hardware, but on software, the machine tools and the software and the exports of those to the Chinese market, as well as some of the high-end cutting-edge semiconductors as well. This new announcement that they're considering and that they're looking at is around aligning the US with its Western allies largely, but also Japan, the UK and the Netherlands in export controls of quantum computing, both software and hardware and other elements within the semiconductor space. So it's a slightly different area that's being targeted, quantum computing, where the US and China are neck and neck in terms of developments and potential consequences for the militaries of both countries, and then additional elements within the semiconductor space that are caught up on this. This is not a US initiative. It's them playing catch up to some extent in terms of export controls that are already in place here in the UK, also in the Netherlands and Japan. The BIS, the Bureau of Industry and Science, in, of course, the Commerce Department, saying this will make it significantly more difficult for our adversaries to develop and deploy these technologies in ways that threaten our collective security.
Interesting that yesterday it was Nippon Steel was a potential security threat to the United States of America, and today it is come on side and support us in our harry against China. One stock which is under pressure this morning, Broadcom. Now, this comes down to their guidance on AI and non-AI business. Differentiate for us.
Yeah, look, this is a stock that's up about 60% year to date. It's clearly under pressure right now, pre-market, as you say. They actually beat in terms of the earnings and in terms of expectations around AI deliveries, the AI chips and components they supply around that business, that division, that actually came up in terms of their expectations above estimates. As you say, it was the forecast around the non-AI divisions that disappointed, and that's what's leading to pressure on the stock. Interestingly, executives said that they think they've got to the bottom in terms of the challenges and the headwinds facing the non-AI divisions of the company. Nonetheless, you're seeing that pressure come through. Morgan Stanley, though, amongst the analysts going through these data points and these earnings, saying they think there's upside here. They've raised their price target to $180 for the stock. They say it's clear that the turnaround is starting to happen in the non-AI parts of the business. Yes, they say AI demand will be non-linear, but the demand is still there.
While we're talking about disappointments, Tom, Intel has been really struggling, starting the week with some 9% decline last week, rather, when it had some of its earnings. And now it's exploring a sale in Mobileye and its stake there. Qualcomm is maybe eyeing up its business design. What sort of contours are we getting of a company that is trying to right-size itself?
Yeah, this is a pivotal moment for Intel, the most consequential moment, arguably, in its 56-year history. And we've had this drip feed of leaks, reports being covered by Bloomberg, Reuters and others, as you say, around the options that are being put on the table at this company. Pat Gelsinger expected to update on those options in the days and weeks ahead, and that's why we're getting this drip feed. One line coming through then, they have this 88% stake in Mobileye. This is this autonomous driving software and hardware business that struggled on its own. They have an 88% stake. They're looking at maybe releasing some capital and some value by selling down that stake. We'll see if that happens. And as you say as well, some of their clients, some of their competitors, the likes of Qualcomm, looking at parts of their business as well. So it seems like Intel are putting all the options on the table in terms of trying to restructure, resize this business. The foundry push continues, of course. Citi, though, putting out a note saying they think ultimately the chances of that strategy being pursued by Pat Gelsinger around building out foundries in the US has minimal chances of success.
Yeah, it's got all the smell of a fire sale at the moment, hasn't it? You just look at the performance on Mobileye, down 70% this year. So the vultures are circling. Tom, thank you very much. Tom McKenzie picking over the bones of Intel and the assets they want to put up for sale. Coming up, Berkshire sells another chunk of Bank of America. Why? Well, we'll have a chat. This is Bloomberg. Bloomberg Brief on Jobs Day. I'm Menace Cranny alongside Danny Berger in New York. Front pages, let's kick it off. This is what we are checking out. We've got the Financial Times, NVIDIA's AI chips. They're cheaper to rent in China than they are here in the United States of America. It costs $6 an hour to rent a server with 8 NVIDIA A100 processors for cloud services in China. And the same cost here, $10 in the US. So the difference signals advanced processors are easy reaching the Chinese market, despite these controls and renewed controls again this morning from Washington.
Probably not happy about that story. No. So next up on the Journal, Bank of America shared non-public information with investors in India that, according to a whistleblower, so company records reviewed by the Journal showed that bankers contacted investors via WhatsApp in March before a $200 million share sale. The bank is investigating those allegations.
And final story, Warren Buffett, Bloomberg's leading with this on Bloomberg.com. His haul from Bank of America, his sales total nearly $7 billion. It's been chipping away at this over the past couple of months, Danny. Liquidated another $760 million since Tuesday. I mean, this comes down to, what is it that's motivating Warren Buffett? I mean, if you've been long, he's been long since where? $5 multiple years ago. So this is what you call return on equity.
Yeah, 2011. I wonder if it's because he sees higher taxes. I was looking through his May shareholder meeting. He said higher taxes are quite likely. The government may decide that someday they don't want the fiscal deficit to be this large. And in order to do that, they're going to take a larger percentage of what we earn. We know Kamala Harris is pitching a 28% capital gains tax. I don't know, could be something in there that maybe he's trying to get out ahead of it.
Listen, this is a very, very smart investor. Either way, he's not bothered about the first 3 months. Apparently, Charlie Mayo over at Wells Fargo said in the first 3 months, after you've got the rate cuts, the cost of your deposits go down, you get a nice boost on the banks. It's the following 3 months. You maybe want to be a little bit more shade, but it's tough.
Fair enough. Mike Mayo there, always very animated. Okay, coming up, it's game day. It's jobs day. We're going to catch up with Citi's Andrew Hollenhorst on your Bloomberg Brief. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
It is the last piece of the jobs jigsaw drops today. Non-farm payrolls are expected to show a hiring bounce. Warning signs from Chicago Fed President Austin Goolsbee. He sees the potential for multiple cuts over the next year. And chip setback, the U.S. doubles down on the China Semiconductor Access Broadcom sales forecast. Disappoints. Danny, good morning. The potential is there from Goolsbee. We'll hear more from him later on today, along with Williams after the jobs report.
Yep, Williams, Waller, those will be interesting to hear from. 11 a.m. is the time to pay attention to that. Two-year yield continues to drop 3 basis points this morning, lowest in 2 years. The setup is very clear for this bond market of how it's been trading going into this report. Continual buying of bonds. Equities weaker this morning, down by 0.6%, weak across the board. Is this a potential for a squeeze if there is a more positive report, considering the dourness of the trade over the past week? Tech really underperforming this morning. Broadcom falling by some 9.5% after its earnings report. Dollar also weaker this morning versus the yen, down about 0.5%. This off the back of those comments from Goolsbee, Manus, saying that he's really concerned about the labor market. Multiple cuts may come. The interesting thing is at 142, the dollar is actually weaker at this point than where it was last month, post that little mini crisis, post the BOJ hike. So that carry trade, it hasn't been a rupture, but kind of a slow bleed ever since then.
Look, absolutely a slow bleed. The dollar has been on the back foot, and I think you're right. The risk reward going into this jobs report is that if you get anything a little bit better than the market is expecting at 165, that is going to reinvigorate Goldilocks and perhaps push back on some of those dramatic moves very much at the short end of the curve, which is it feels as if we're in a precarious moment of where we're like one breath away from ratifying a 50 basis point cut.
Yeah, I mean, we're so skittish about this report, but I go back to what Goolsbee said yesterday. I don't want us to be basing a decision on one data point. So it leads to this question: is the market overweighting the importance of today's report? Marija Veitmane certainly thinks so at State Street, but that being said, she's incredibly bullish. So basically anything would make her want to buy stocks.
I like what she said, which, bad news is bad news, but it's got to be very, very, very bad news, which is almost like a negative jobs trend, which nobody has put on their dance card for this one. So at the moment, I think it's going to be that fill or kill on whether it is 50 or 25. Joining us to put some context around the numbers, it is Mike McKee. He is with us here this morning. Mike, good morning to you. So as Danny said, the risk reward here is 114 last month, 165 is consensus here. Maybe we should be a little bit more focused on the unemployment rate and what's driving that.
Well, the unemployment rate is the number one indicator that the Fed has cited for their thinking. Now, the question is, do they care about how far out unemployment goes to 3 digits or whatever? Will that influence them? We are looking at 165,000, as you say, although interestingly enough, you said Wall Street's thinking. Wall Street is thinking 150. That's the whisper number. It's the economists who are thinking 165, which surprised me because we've had a lot of negative jobs numbers in some of the other indicators this week, and nobody has really changed their forecast. But 4.2% is the unemployment rate. That would be a tick down from last time. And there are a lot of questions about whether last time was unusual. If you go under the hood of the unemployment rate, most of what we saw, or a very large part of what we saw in terms of the unemployment rate rising to 4.3% last month, was because a lot more people were listed as on temporary layoff. That is the light blue on the, if you look all the way to the right, actually it shows up on your screen, I guess, as sort of pink mauve, sort of like Danny's jacket
I'm
color.
matching it, yeah.
Yeah, she matches it. The increase there is expected to reverse. A lot of those people may have been auto workers who were out of work because of plant retooling, and some of it is weather. And if that happens, we could go down to 4.1. If we go above 4.2, that's what's going to scare people. And the question then is, did we go above 4.2 because we got to a rounding situation, or because we got out to 3 digits and rounded up to 4.2 or 4.3, or because we actually saw the rate jump that much?
Got you.
Yeah, so I love every time you give us the jobs data, you need to tell us by like the 100th or even the 1000th of a percent.
It's gotten to that point.
It really has.
Andrew Hollenhorst is here, and we were talking about that earlier before the show. It's like, is this a way to make policy on the 3rd digit?
Okay, but is the Fed making policy based on that, or is this just a market that assumes that they are?
Well, the Fed is going to have a lot of things to think about. I mean, imagine you're in that room. Not only do you have what's the trajectory of the labor market, and what's the trajectory of growth going forward? Where's inflation? But we also have the geopolitical stuff out there, and you've got the election, and we don't know how that's going to influence it. And monetary policy isn't going to hit if they do something till next year. So they've got to juggle all this stuff in there. So maybe a 3rd digit doesn't matter so much. But it'll be interesting to watch today. You look at Fed funds futures and overnight index swaps right now. They've actually come in a little bit, fewer than 1.5 cuts now. So we'll see where they end up at 8:30, and then the yield curve is disinverting again.
Twice in the space of a month,
So where does that go? Things to watch today.
Mike, looking forward to you breaking the data. Let me know what color charts you're going to use after the data break so I can make sure I can match it again next time.
You did a great job today.
Thanks, Mike. Okay, Mike McKee there. And later today, Acting Labor Secretary Julie Su will be joining Bloomberg Open Interest at 9 a.m. New York time. Let's get another estimate for what we're likely to see today. Citi's Chief Economist Andrew Hollenhorst sees 125,000 jobs added in August with the unemployment rate at 4.3%. He goes on to write, this would confirm that softer July data was not just due to temporary factors, but rather reflects true weakening in labor market demand. We expect this to lead the Fed to cut by 50 basis points in September. Pleased to say Andrew joins us now. Andrew, thanks so much for being in here nice and early this morning.
Yeah, my pleasure.
So you've said for some time that the bar to cut for 50 basis points is lower. It's certainly lower than many folks would see out there. Is there any piece of data today that would convince you it's 25, or is it clear we're on a course for 50 basis points worth of cuts?
Well, I think there are two discussions here. One is kind of what is the trajectory of the labor market? What does the Fed need to do? We heard that from Chicago Fed President Goolsbee last night, I think being very clear that it's the time to cut now and that there will be multiple cuts coming. Then there's this question on what the Fed would call tactics. Are you going to cut 50 basis points or 25 basis points when you start the cutting cycle? And that will depend on today's jobs report. And like Mike was discussing, it could come down to hundredths of a percentage point on the unemployment rate. 4.3%, I'm very convinced they're going to cut 50 basis points. 4.2%, probably a 25 basis point cut. And we have all these marginal cases. We'll be listening to Williams. We'll be listening to Waller. What are they going to tell us?
So this is how nuanced it has become, as we've just said. It's whether it's rounding or whether it's actual. Talk me through your thinking and what is it that's pivoted you from Goldilocks soft landing to a recession? Because the market's gone from 6 cuts to virtually no cuts to 4 cuts and now 50 basis points on the docket. So what tripped you over from Goldilocks to recession?
Yeah, so we've been consistent on this, thinking that the Fed raised rates to restrictive levels. That's meant to slow the economy, and that would happen with maybe a significant lag. And I think those lags have just caught up to us now. So what we've been watching over the last 6 months is a consistent story in the labor market. And I think that's where we should really be putting today's single monthly jobs number in the context of an unemployment rate that's risen almost 1 percentage point. So it's not just the July report that we're talking about and what happens in August. It's really this transit upward in the unemployment rate. What we saw in the JOLTS data earlier this week, where we have the hiring rate that's come down and hiring that's very subdued. So I think what a lot of people are looking at now is a job market where they're saying, well, we're not seeing these big layoffs, so things must not be that bad. And that's true right now. The problem is, as that hiring rate comes down, it's telling us that firms are becoming less and less excited about growing their labor force. And the next move that you typically see in a cycle is that move towards layoffs. So I think that's what we should all be concerned about here.
Well, and you mentioned this earlier in the show, Manus, that Paul Donovan of UBS has this whole thing where it's like the number itself doesn't actually matter. It's people's perception of the number and whether people start making decisions based on if they feel hiring isn't as robust. How close are we to that sort of environment where consumers think, hey, if I leave my job, I'm unlikely to get hired, or if I don't have a job, I'm unlikely to get one, and I will change my behavior based on that?
So those are some of the concerning numbers that we're seeing now. If you look at some of the survey numbers, people are saying they're finding jobs harder to get. They're more worried about losing a job. That does affect behavior. And again, as you're going through this cycle, you're looking for, have we hit that inflection point? Have we hit that inflection point where people actually pull back on their spending because they're worried about their job prospects? I think we're close to that now.
You talked about the acceleration in unemployment going up by 1% over that period of time. Are you expecting a shallow and short dip in this economy or something more negative?
Well, I think we will see the unemployment rate that not only moves higher, but accelerates higher because we have these kind of typical nonlinear dynamics. Last month, part of what we were talking about was the so-called SOM rule being triggered or almost triggered. And that is this empirical regularity where what looks like a soft landing, what looks like a very slow softening of the U.S. economy tends to accelerate. So I think we're right at that point now. And again, that's the context in which I'm viewing today's report.
I mean, you have a very holistic view of things. Just to get back to this idea that hundredths of a percent or thousandths of a percent make a difference for the Fed, are we just missing the forest for the trees, essentially? Have we gotten too bogged down in the data? And I ask that has the Fed and has the larger investing community done it? Because there's a differentiation between what we think the Fed will do versus what they actually do.
Yeah, I think this is so similar to what we did with inflation, where we do all this work also, right? You do the very detailed work on inflation. You look at all the subcomponents. You try to get those hundredths, those thousandths of a percentage point right, because you want to figure out where the number is going to come in. That is going to determine what the Fed is going to do. But then you also need to then step back from that analysis and say, where's the trend in this data actually going? We see this clear softening trend in the labor market. That's what Goolsbee was talking about. That's what Powell was talking about at Jackson Hole. I think that's just very, very clear now. Now, there is a really interesting discussion on these temporary layoffs. Are they going to be really temporary or more persistent? Those are interesting stories also. We want to be watching for those things in today's number. But I think this bigger macro trajectory is more important.
So the the deceleration that you're talking about then brings into question how quickly we get to neutral and where that is. Paulson was here yesterday, John Paulson, talking about 2.5%, 3%. How quickly do you think this cutting cycle could become?
Yeah, so I think we could really accelerate the cutting cycle, and we see the market pricing some probability of that, right? They could go 50 in September. Not only could they go 50 in September, they could go 50 again in November. And if the unemployment rate continues to rise, why wouldn't you? And I think that's what I come back to when I think about the Fed. Pretty much every Fed official.
But that's the unwelcome softening that Powell does not want.
That's the unwelcome softening. They would not welcome any further softening of the labor market. And they all think that policy rates are restrictive at this level. So if you think you're restrictive, you don't want any further softening, why wouldn't you be reducing rates pretty rapidly?
What difference does November make, the outcome of that? If you have Trump yesterday talking about lowering corporate taxes by 15%, emphasizing that he wants to use tariffs, divergence from Kamala Harris, who wants a 28% capital gains tax. So what difference would that make for the outcome of 2025?
I mean, I think we know how the Fed will respond to this, which is that they will try to stay as far away from this as possible. And essentially what they'll say is, all future policy is uncertain. We're going to wait until we see not just the future policy, but how that policy affects the economy. Because even if we knew exactly the policy, you could have a couple different economists on this show, and they would disagree on what the economic effects are going to be.
Can we just close off? There's the disinversion a couple of times in this yield curve. How important is that for you? Just briefly, just round it off for us.
Well, I mean, we've been inverting and disinverting intraday, right? Just watching that. Yeah. So, I don't think that, are you plus 1 basis point, minus 1 basis point on the slope of the yield curve is the important point. The important point is that we're at this inflection point in the labor market. Gotcha. As we're hitting the inflection point in the labor market, we're hitting an inflection point in interest rate markets, and you're seeing that curve disinvert. It's all consistent.
Andrew, thank you very much for being with us this morning. That's Andrew Hollenhorst of Citi. Coming up in the show, U.S. targets China with fresh chip export curbs. We'll discuss the implications on Bloomberg. It is Bloomberg Brief. I'm Anna Scranny alongside Danny Berger in New York. Well, the chip stocks this morning, they lead the futures lower. The U.S. is joining its allies in imposing chip-related export curbs targeting China. Let's get to Tom McKenzie. He's been tracking the story for us. Tom, when we look at this story, just how much of an escalation is this? It sounds as if it's focused on the higher end and around quantum computing, but just run us through the escalation of these curbs.
Yeah, so this is a plan by the US to, on some levels, catch up with its allies, including the UK, which put in similar measures in April, but also Japan, more importantly, and the Netherlands. This is a worldwide export ban, then, restriction on elements, hardware and software that go into quantum computing. So that's a new element. They haven't targeted quantum computing before. And then some of the hardware still within the semiconductor space. Now, there are carve-outs, and the carve-outs are important. The carve-outs are for those allies like Japan, like the Netherlands, that have put in place similar restrictions, export controls. And that is something of an incentive for others to get on board with these measures, because if you don't have access to the technology from the US, it's very hard for you to innovate in that space. But yes, China will be part of the target, of course. And we had a statement coming through from the Ministry of Commerce, the Department of Commerce in the US, saying that these measures will make it significantly more difficult for our adversaries, and of course you can put China in that category, to develop and deploy these technology in the ways that collectively or affect or threaten our collective security. So it's an additional measure. The most consequential go back to October 2022, when you had the ban on everything from GPUs coming through from NVIDIA, the A100s, the H100s, plus the hardware, plus the software, and the ability to maintain those pieces of equipment on the ground in China. That was the earthquake moment in October 2022. But since then, we've had a rapid catch-up in terms of tightening these restrictions, and this is a further step in that direction.
And then we had Broadcom yesterday, Tom, down nearly 9% in the pre-market trade. It was a forecast that disappointed. What was behind that disappointing forecast?
Yeah, look, here's the context. The stock has rallied year to date, right? 50, 60%. Now it's under pressure. The earnings for the quarter were a beat, but it was the forecasts, and particularly the forecasts around the non-AI divisions of Broadcom, because this is an expansive business. And that's where the concern were, because those forecasts, 14 billion versus 14.1 billion, clearly a miss. In terms of the AI divisions, though, the outlook for that sector and that segment of the business was actually more positive than the analysts had expected. But they're clearly focused on the supply that Broadcom has in terms of the software and hardware in parts of this ecosystem above and beyond the AI part that's done so much to power the stock higher. So you're seeing that pressure come through for the company. It's interesting that the CEO said, look, in terms of the downturn, the headwinds for the non-AI divisions, so supply, for example, to EVs and cars, as one example, that has started to bottom. He sees a brighter picture ahead. And some of the analysts out there, including Morgan Stanley, agree with that view. But for the moment, clearly the stock is under pressure.
Tom, appreciate it. That is Bloomberg's Tom McKenzie. Okay, a quick check on the bond market. We are counting down to the payrolls data and whether it means 25 or 50. 43% odds of a 50 basis point price into this market at the moment. 2-year yields are trading at their lowest level in nearly 2 years. 10-year yields are at their lowest since 2023. That trend continues across the curve lower by about 3 basis points. So it is a highly anticipated jobs report and the ensuing rate decision 2 weeks later. And even with that uncertainty, the debt market has been the winner. It has been absolutely gangbusters. $43 billion priced on Tuesday. This week has been one of the busiest for U.S. investment-grade bond issuance since 2020. Let's bring in Bloomberg's Ronan Martin for more on this. Ronan, it's a period where there's a lot of macro uncertainty, but corporates are not waiting. What's behind all the issuance?
Yeah, it's been crazy busy. We've seen 55 billion euros in Europe this week. That's following 63 billion euros last week. As you said, a record day in the US on Tuesday, and they're up to about 80 billion this week already. It's the 5th busiest week over there. And that's kind of following the crazy weeks during the height of COVID when companies are desperate for cash. Even Asia, had the 2nd busiest week for APAC issuers doing US dollars. And it's really, companies have come back from summer breaks. It's September. Investors are back. They've accrued cash over the summer and they're ready to go. They're looking to get stuff on their books now, lock in debt while they can, and companies are fully taking advantage of that.
There's also the buyer side of it, Ronan, as well. They want to lock in. You can get 4.89%,
yeah.
4.9%. So it's obviously the last hurrah at the bar there as well before these rate cuts actually start to get going. What about JP Morgan? What are they telling us in terms of the funding for M&A?
Yeah, it's interesting. We've seen a bit of M&A funding. Over here, we've had SES, which is acquiring Intelsat to try and compete with Elon Musk's Starlink. They did hybrid bonds to, I think it was about $1 billion, hybrid bonds to fund that M&A, replacing some of its loans outstanding. But we have started to see kind of M&A trickle back in. I know it's one of the big things that, especially in the loan market, the bank loan market over here, people have really been waiting for that.
Okay, Ronan, thank you so much. Ronan Martin there on the very latest on the credit markets. Coming up in the show with Danny and myself, we're kind of down to this jobs report. We're down to rounding up or rounding down. We'll give you all the Fed speak in just a moment. Good morning from New York.
It's your Bloomberg Brief on this jobs day. Danny Berger and Manish Cranny in New York. Let's get you set up for the trading day. It is the main event. It is game day. We're going to have your August jobs report. That comes out at 8:30 a.m. Eastern. More Fed speak. We're going to have New York Fed President John Williams at 8:45 a.m. Eastern. And the thing that has been billed by some is more important than the jobs report is Fed Governor Christopher Waller at 11 a.m. Because, Manis, maybe the data doesn't matter. It's the reaction by the Fed to the data.
Absolutely, and what kind of guidance we get from them. Just thinking about the Fed speak overnight, we've touched on this a couple of times. From Mary Daly, it's about a downward descent. From Goolsbee, it's about the potential for multiple cuts over the next year. And we both just sort of sat down and said this in the break, which is the risk in this market, we're primed for pessimism. What's the risk of actually a good jobs number? I mean, you look at that bond market, it is like, it's like on a rubber band. And if you get a good jobs number, those rates, which have collapsed by 60 basis points in the past month, could certainly ratchet higher.
Yeah, to be fair, it's both negative equities this week, not to the same extent as the rally in the bond market. But bonds, the 2-year yield is currently at its lowest level in 2 years. The 10-year yield is at its lowest level since June 2023, despite what we could say is mixed data. You had strong ISM services yesterday. You had jobless claims that were better than expected. Well, they were lower, but in the good way. And still we're pricing in about 43% odds that they go 50 basis points next meeting.
Look, it certainly feels that we're at some kind of precarious point of where we're primed for a tough set of data. That can put 50 basis points in play. That's what the bond market has got. We're at an inflection point. That's what Citi, the conversation we just had there now, we're at an inflection point in terms of the jobs market, in terms of the rates market. And don't get all hung up on a disinversion in your yield curve. That was certainly the message, wasn't it?
The whole thing from Andrew Hollenhorst is it's about the trend. Even if you get something like 4.2% on your unemployment rate, the trend is still the same, and it is one that is growing. And it's what we heard from Goolsbee yesterday. The trend is concerning. It's not one piece of data that changes my mind.
It is about the fear of losing your job. That is what you're going to find out in these jobs numbers. If they're not firing people and that's not accelerating, the fear is less. Surveillance to take you through the numbers.